Hello friends, good morning. Today we'll discuss about the India's 115, that is the revenue recognition, and what how the revenue is recognized after the India's 115, and what are the procedures, scopes, and other procedures and guidance that is mentioned in India's 115 will be discussed here in this video. For which if you have any doubt and query, please let us know in the comment. We will reply at the earliest possible. So we are begin with this video for the India's 115 scope. The standard applies to all contracts with the customers except the following: lease contracts within the scope of India 17, leases, insurance contracts within the scope of AS 104, insurance contracts, financial instruments, and other contractual rights or obligations within the scope of India's 109, financial instruments in India's 110, consolidated financial statement India's triple one, and joint agreements India's 27, separate financial statement India's 28, investment investments and investment in associates and joint venture India's 28. Okay, non-monetary exchange between the entities in the same line of business to facilitate the sales to customers or potential customers. For example, this standard would not apply to a contract between two oil companies that agree to an exchange of oil to fulfill demand from their customers in different specified locations on timely basis. India's 115 applies only if the counterparty to contract is a customer. Customer is a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. A counterparty to a contract would not be a customer if for example, the counterparty has contracted with the entity to participate in the activity or process in which the party to contract state party to a contract shares in the risk and benefits that result from the activity or process, such as developing an asset in the collaboration agreement rather than to obtain an output of the entity's ordinary activities. Identifying the contracts. An entity shall account for a contract with customer only when all the following conditions are met. Part, the party to the contract has approved the contract in the writing, orally, or in accordance with other customer business practices, and are committed to perform their respective obligation. The entity can identify each party rights regarding the goods or services to be transferred. Entity can identify the payment terms for the goods or services to be transferred. Contract has the commercial substance, risk, timing, or the amount of the entity's future cash flows is expected to change as a result of the contract, and it is probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. In evaluating whether collectibility of an amount of consideration is probable, the entity shall consider only the customer's ability and intention to pay that amount of consideration when it is due. The amount of consideration to which the entity will be entitled may be less than the price stated in the contract if the consideration is variable, because the entity may offer the customers the price concession. A contract is an agreement between two or more parties that creates the enforceable rights or obligation. Enforceability is a matter of law. Contracts can be written, oral, implied by the entity's customer business practices. For example, for the purposes of applying this standard, the contract does not exist if each party to a contract has the unilateral enforceable right to terminate a wholly unperformed contract without compensating with the other parties. If a contract meets the criteria mentioned above as a contract inception, then entity shall not reassess those criteria unless there is an indication of a significant change in facts and circumstances. If it does not meet the criteria, then the entity shall continue to assess the contract to determine whether the criteria are subsequently met. When a contract does not meet the given criteria and an entity receives consideration from the customer, then it shall recognize the consideration received as a revenue only when either of the following revenue events has occurred. The entity has no remaining obligation to transfer goods or services to the customer, and all or substantially all of the consideration promised by the customer has received by the entity and is non-refundable. Contract has been terminated, and the consideration received from the customer is non-refundable. A contract modification is a change in the scope or price or both of a contract that is approved by the parties to the contract. It shall be accounted for as a separate contract if both the following conditions are present. Scope of the contract increases because of the addition of the promised goods or services that are distinct, and the price of the contract increased by an amount of consideration that reflects the increased standalone selling price of the additional promised goods or services, and any appropriate adjustment to that price to affect the circumstances of the particular contract. If contract modification is not accounted for as a separate contract, then an entity shall account for promised goods or services not at transfer date, the date of the contract modification, that is, the remaining promised goods or services is in whichever of the following ways is applicable. Amount for as it were a termination of existing contract and a creation of new contract. If the remaining goods or services are distinct from the goods or services transferred, the amount of consideration to be allocated is the sum of consideration promised by the customer, including the amount already received from the customer that was included in the estimate of the transfer price and that had not been recognized as revenue, and consideration promised is a part of the contract modification. Amount for as if it were a part of the existing contract if the remaining goods or services are not distinct and therefore form part of the single performance obligation that is partially satisfied at the date of contract modification. If remaining goods or services are a combination of items A and B, then effects of the modification on the unsatisfied, including the partially unsatisfied performance obligation in a modified contract, shall be accounted for in manner that is consistent with the objective of this paragraph. Identify the performance obligation. At contract inception, assess the goods or services promised and identify as the performance obligation. Each promise to transfer to the customer either goods or services or bundle of goods or services that is distinct, or a series of distinct goods or services that are substantially the same and that have the same pattern of the transfer to the customer. Distinct goods or services. The goods or services is distinct if both the following criteria are met. Customer can benefit from the goods or services either on its or either on its own or together with the other resources that are readily available to the customers, that the goods or services is capable of the distinct, and it is promised to transfer the goods or services to customer is separately identifiable from other promises in the contract, that is the promise to transfer the goods or services is distinct within the context of the contract. Satisfaction of the performance obligation. An entity shall recognize revenue when or as the entity satisfies the performance obligation by transferring the promised goods or services that is an asset to customer. An asset is transferred when or as the customer obtains the control of that asset. For each performance obligation identified, determined upon at a contract inception whether it satisfies the performance obligation over the time or at a point in time. If an entity does not satisfy the performance obligation over the time, the performance obligation is satisfied at a point in time. Performance obligation satisfied over the time. A performance obligation satisfied over the time if one of the following conditions are met. Customers simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. The entity's performance creates or enhances an asset. For example, work in progress that the customer control as the asset is created or enhanced. The entity performance does not create an asset with an alternative use to entities, and the entity has an enforceable right to payment for performance completed to date. For some time of performance obligations assessments of the above would be straightforward. For other types, entity may not be able to readily identify whether customer simultaneously receives and consumes the benefit from the entity's performance as the entity performs. In those circumstances, a performance obligation is satisfied over the time if the entity determines that another entity would not need to substantially re-perform the work that entity has completed to date, if that other entity were to fulfill the remaining performance obligation to the customer. In assessing whether an asset has an alternative use to the entity, an entity shall consider the effect of the contractual restrictions and practical limitation on the entity's ability to readily direct that asset for another use, such as selling it to the different customer. A contractual restriction must be substantive, that is, customer would enforce his right to the promised asset if the entity sought to direct the asset for another use. An entity has the right to payment for performance completed to date if it gets an amount that would compensate an entity for performance of completed to date, which is an amount that approximate the selling price of the goods or services to transfer to the date. For example, recovery of the cost incurred by the entity in satisfying the performance obligation plus a reasonable profit margin rather than compensation for only the entity's potential loss of profit if the contract were to be terminated. For each performance obligation satisfied over the time, recognizes revenue over the time by measuring the progress towards the complete satisfaction of that performance obligation. Appropriate method of measuring progress includes outputs methods and inputs methods. In determining the appropriate method, entity shall consider the nature of the goods or services that the entity promised to transfer to the customer. Output method recognizes revenue on the basis of direct measurement of the value to customer of the goods or services transferred to date relative to remaining goods or services promised under the contract. Input method recognizes revenue on the basis of entity's efforts or inputs to the satisfaction of the performance obligation. For example, resources consumed, labor hour extended, or cost incurred, time elapsed, machine hours used relative to the total expected inputs to the satisfaction of that performance obligation. These two methods on which the revenue can be recognized. When as the performance obligation satisfies, recognizes the revenue amount to the per transaction price, which excludes estimate of the variable consideration that are constant, that is allowed to that performance obligation. Determining the transaction price. Entities shall consider the terms of the contracts and the customary business practices to determine the transaction price. The transaction price is the amount that the entity expects to be entitled to exchange for transferring the promised goods or services to the customer, excluding the amount collected on behalf of third party. For example, say some sales tax. The consideration promise may include fixed amount, variable amount, or both. Variable consideration. If a consideration promise in a contract includes a variable amount, an entity shall estimate the amount of consideration to which the entity shall be entitled in exchange for transferring the promised goods or services to the customer. I estimate amount of the variable consideration by using either of the following method. Expected value. The expected value is the sum of probability weighted amount in the range of the possible consideration amount. Unexpected Expected value may be an appropriate estimate of the amount of the variable consideration if the entity has a large number of contracts with the similar contracts. The most likely amount is the single most likely amount in the range of possible consideration, that is the single most likely outcome of the contract. The most likely amount may be an appropriate estimate of the amount of the variable consideration if the contract has only two possible outcomes. That is, for example, entity either achieves a performance bonus or does not. At the end of each of the reporting period, entity shall update the estimate transaction price, including the updating its assessment of whether an estimate of variable consideration is constant. The existence of the significant financial component in the contract. In determining the transaction price, entity shall adjust the promised amount of consideration for effect of the time value of money if the timing of payment agreed to by the parties to the contract either explicitly or implicitly provides the customer or entity with a significant benefit of financing the transfer of the goods or services to the customer. Non consideration measurement of non cash consideration promise of the non cash consideration at a fair value if it cannot reasonably estimate the fair value of the non cash consideration, then measure the consideration indirectly by reference to standalone selling price of the goods or services promised to the customers or class of customers in exchange for a consideration. Allocating the transaction price to performance obligation. Allocate the transaction price to each performance obligation identified in the contract on a relative standalone selling basis. To do so, our entity shall determine the standalone selling price at a contract inception of distinct goods or services underlying each performance obligation in the contract, and allocate the transaction price in proportion to those standalone selling prices. The standalone selling price is the price at which the entity would sell or promise goods or services separately to customers. The best evidence is the observable price of the goods or services when the entity sells that goods or services separately in similar circumstances to and to similar customers. Allocation of a discount. A customer receives a discount for purchasing the bundle of goods or services if the sum of the standalone selling price of those promised goods or services in contract exceeds the promised consideration in a contract. An entity shall allocate a discount entirely to one or more, but not all performance obligations in the contract if the following conditions are met. The entity regularly sells each distinct goods or services or each bundle of distinct goods or services in the contract on a standalone basis. The entity also regularly sells on a standalone basis a bundle or bundles of some of those distinct goods or services at a discount to stand-alone selling price of the goods services in bundle. A discount attributed to each bundle of goods or services is substantially the same as discount in contract, and an analysis of the goods or services in each bundle provides observable evidence of the performance obligation or performance obligation to which the entire discount in the contract belongs. Okay, so this is, we have discussed the 20 pages of the, this is the ICI material regarding the IND AS 115. If you require, we will continue with the same discussion of IND AS 115 for further discussion regarding the IND AS 115. And this is a very good aspect of how the accounting system works. And now after the convergence with the India accounting standards with the IFRS, because of globally recognized, the IFRS has been globally accepted, and so the India has now converged all the accounting standards with the IFRS, so that it can be globally standing in the global. So there is no question of any question in the mind of the global investors with the Indian accounting systems or the financial statement prepared for that particular state. So this is what we have discussed today in this video for India's 115, and we will continue with this discussion regarding the India's, and for the further chapters are like there are many more Indias are applicable. So we are going to discuss each one by one at the inception. There is no scope of further discussions. So if you will continue this video, you will come to know about all the Indias one and why. So thank you in this video. If you have any question, please let us know in a comment, and we will continue with this video. And please don't forget to like and subscribe, and forward this video to your family or friends for more such contents. And don't forget to press the bell icon given in the below video description button. Thank you.